got a house here and I'm trying to refi it. I've lived in town for 40 years and want to die here. So I'm looking to refi my loan. The problem is I'm old, but I have assets, and none of the lenders want to take my assets, my cash assets, as stated income. It's a problem.
Okay. I understand the problem. Okay. And I can address it.
Talk about it.
I'll address it. How about you folks?
Yeah, we're also interested in refinance.
Okay. Okay. Thank you.
I'm just here to learn about
Just
investing.
Okay.
Long-time Laguna resident, renter currently, have owned a home, is interested in what's going on with the market.
Okay. We're back.
Currently rent, we'd like to buy a home in town.
Okay. All right. Well, you know, a small group, but there's a lot of diversity within the group. Some own, some rent, some want to buy, some did own, maybe don't want to anymore, maybe want to, but not quite ready. And you're struggling to refinance because the guidelines aren't making sense to you. And you know, all real common stories. I hear that stuff all the time. I've been in the mortgage business for 36 years. I have my own company here in Laguna Beach. It's called RTC Mortgage Corporation. I started it myself about 10, 12 years ago. But prior to that, I was a corporate guy and worked for a couple of the big companies. So mortgages are really all I know how to do. And there's a lot of material I can cover today. I'm just going to go quickly because we've got to leave time for the questions and answers, and that's really the most important part. Basically, there's two general groups or buckets or types of mortgage lenders. There's the independent mortgage brokers such as myself. I deal with a lot of different banks and different mortgage companies that provide funds. You know, I've got a lot of lenders, I've got a lot of programs, I've got, generally speaking, access to better rates than the big banks would offer you. As a general rule, mortgage brokers are more experienced than the guys that work for the big banks. And we process our loans locally, so we've got control, a lot more control over what happens. One of the stories I hear so often from people trying to refinance is they went to one of the big banks, got bogged down, the processors in some other part of the country, or maybe in some other country, and you just can't communicate, and either fits the box perfectly or you're out and they can't really explain to you why. A real common problem. To understand the root of those problems, you have to understand where the mortgage money comes from. And most of it in the United States comes from Fannie Mae and Freddie Mac. They provide the financing. I'll explain briefly who they are, what they are, because without knowledge of who they are, what they are, the rest of the story doesn't make sense. But basically they were created years ago in 1938 by the federal government, and basically they act as a clearinghouse. They make their loan programs available to all lenders that meet their criteria. They make up the loan rules, they make up the guidelines, they make up the loan programs, and basically the interest rates and the pricing is the same for everybody as well. And they make their products available to all lenders in the country. Lenders will make the loans. As soon as they finish making them, they'll turn around and sell them back to Fannie Mae and Freddie Mac. That gives them, the banks, that is, or the lenders, their money back, and it recycles the money so they can lend it again to the next person. And then Fannie Mae and Freddie Mac take all those loans, they bundle them together with loans they've acquired from other lenders, and they create what's called a mortgage-backed security. And those securities are traded in the financial markets along with other stocks and bonds. And it's the pricing of those mortgage-backed securities that controls or dictates the interest rates on the loans, and they change every day, all day long. So it kind of takes away the ability for anybody to realistically shop for a loan, because most of the money comes from the same source, and the price is constantly changing. But the federal government took over these two agencies a few years ago when they failed, when the whole mortgage meltdown began, and we're fortunate that they did, because they were responsible for, between Fannie Mae, Freddie Mac, and FHA, we're talking well over 95% of the mortgage money in the United States right now. Loans are broken down into two categories. There's conventional, which is your conforming loans that are saleable to Fannie Mae, Freddie Mac, and it's the jumbo loans that we'll talk about in a little bit more. And there's government loans, the main one being FHA, and the only difference is the FHA loans are insured by the federal government. So if the federal government owns Fannie and Freddie and they insure FHA loans, that pretty much tells you the government's got their finger in our pie pretty heavily, and they control a whole lot of the mortgage industry. I'm going to go kind of quickly, jumbo loans are the loans that don't fit the Fannie Mae Freddie Mac guidelines, usually because they're larger loan amounts. And up until the mortgage meltdown, there was a readily available secondary market for jumbo loans, just like their Fannie Mae and Freddie Mac provided the ability for lenders to get their money back to relend to the next guy. That all went away when the whole mortgage crisis began. And to this day, jumbo lenders don't have a source to sell their mortgage loans to. So they have to make it with the realization that they could theoretically own that loan for 30 years. So there's a lot more demand than there is supply for the jumbo money. The guidelines tend to be more strict in most cases. And each lender can set their own set of rules. They're not the same for every lender like they are for Fannie Mae, Freddie Mac lenders. FHA loans, like I said, they're insured by the federal government. They're the most liberal type of loan, meaning you can buy with as little as 3.5% down. And I put up a chart here that shows you the down payment requirements. If you want to get an FHA loan, 3.5% is the smallest down payment loan of anything I'm aware of. Loan amounts in Orange County can go as high as $729,000 for an FHA loan. Conventional loans up to $417,000, which is the basic limit for Fannie Mae and Freddie Mac loans. Those allow 5% down payments. If you go above the $417,000, but to the maximum limit allowable in Orange County, which is $625,500, you need at least 10% down. And if you're talking about jumbo financing, larger than that, you need at least 20% down. And when you get into the really large loan amounts, above $1 million, above $2 million, $3, $4, $5 million, the down payment requirements become even larger than 20%. Okay? If you own a house and it's underwater and you're frustrated because you can't refinance, there is some relief. This program is called HARP. It's been around a couple of years, but there's a new version of it coming out really this month. By April 1st, most lenders should have it available. It enables you to refinance your house regardless of how underwater it is. Underwater meaning you owe more than the house is worth. If your loan is owned by Fannie Mae or Freddie Mac, and there's an easy way to find out if it is. They both offer a website. I've got the address up there, and I can easily email you my presentation if you want to look it up when you go home. There's a few other rules for that program. Your loan has to have been originated before May of 2009. You can't have refinanced it earlier under the HARP program. You have to be current in your payments. So there's a variety of rules, but if you are underwater or know somebody that is, and their loan's owned by Fannie Mae and Freddie Mac, who, by the way, own a little over 50% of all the mortgages in the country still, and they're responsible for the loans of about 75% of the loans that are made in the country. So they have a huge, huge part in it. Another thing that comes up to me virtually every day, maybe every hour, is people that have had a previous short sale, bankruptcy, foreclosure, and want to buy again or refinance if they own another property. And there are a lot of rules about that. There is a waiting period depending on whether you had a foreclosure or a short sale. And if it was a bankruptcy, depending on what type of bankruptcy it was, there's a mandatory waiting period regardless of how good your credit has gotten since then. Okay? And there's waiting periods generally range 2 years, 4 years, or 7 years for a foreclosure. And again, not enough time to go into a lot of detail here. And the rules are a little bit different for conventional financing, which that slide is for, versus FHA financing. FHA, again, being a little bit more liberal if you're trying to buy again after a previous short sale foreclosure. Interest rates, as I said earlier, for Fannie Mae, Freddie Mac type loans, which is the great majority of loans, they're not set by the federal government, they're not set by the lenders that you're dealing with, they're set by the supply and demand of these mortgage-backed securities that are traded in the financial markets. And I get streaming quotes on my computer all day long, just kind of watching the movement of them. It's a fast-moving process, but that's how mortgages are priced today. We're talking Fannie Mae, Freddie Mac, or FHA loans. I'm going to skip a few slides here because they get into just more detail of how they're priced. And Fannie and Freddie, one thing I will touch on here, not everybody gets the same rate or the same terms. There are a variety of different factors that influence how much of a rate you'll get or how much of a premium you might pay for your rate. depending on the amount of equity you've got and the credit score you have and some other factors. Again, I can give this presentation to anybody after the fact, but if I stood here and explained it all, we'd be here pretty late. We can talk about whether you're paying points or not. The only point I'll make with that is if you want, everybody says, I want to pay points. Well, the bottom line is if you pay a point, you're going to get a better interest rate. So take a look at it. If you're thinking about refinancing or buying and want to pay, somebody's suggesting you pay points, the longer you keep the house, the more you'll be ahead in the long run by paying points. So don't be totally opposed to it up front. The process is really not that complicated. We take an application, we run your credit, we input that into a processing system, and Fannie Mae and Freddie Mac give us a automated processing or underwriting program that we upload it to. We get answers back in seconds, literally. And when I've got an approval from Fannie Mae or Freddie Mac, I can deliver your loan to any lender in the country and know with certainty that it will be approved. It's that streamlined and simple. Documenting a loan is fairly simple, it's straightforward, and as a general rule, we just need to know where you've worked for the last 2 years, how much money you make. If you're employed, it's pretty easy to determine. If you're self-employed, it's more difficult. You need 2 years tax returns. You have to have been self-employed with the same business for at least 2 years, and there's a variety of other criteria. But if you're dealing with somebody that knows the criteria up front, you're not going to have a problem qualifying, or if you do, you're going to know it early on, not at the end of the game. When qualifying, the most important issue, everybody wants to tell me, the first thing they want to tell me out of their mouth is what their credit score is, like they want to brag about it. It doesn't really matter that much. What really matters is the ratio of your debt to your income. That's number one. Okay. What about in traditional financing? These guys might have a different perspective on that because they do different types of loans. But traditional lending, it's all about the ratio of debt to income. Okay, you can have a credit score as low as 620 and still get a mortgage. But if you don't have the income to support it, it doesn't matter how good your credit score is, it's not going to help.
What about the cash reserve? You just what you wouldn't.
Cash reserves varies. When it's Fannie Mae, Freddie Mac, or FHA, it's very little. It can be almost nothing. Generally speaking, 2 or 3 months payments in reserve is really all you really need. If it's a jumbo loan and you're dealing with loans above the $625,000 limit, $1 million, $2 million, the jumbo lenders almost always have cash reserve requirements. The most basic one is a year's worth of payments in the bank after you close your transaction. Okay. If you're borrowing $3 or $4 million, they might even want more than that. Okay, so as a general rule, about a year's worth of payments, and that's a lot of money to have in reserve, particularly when you're dealing with payments that are, $8,000 or $10,000 to begin with. So I understand that. I think I'll open it up for questions at this point. So I covered kind of the basics. I know it was quick, but I hope you've got some questions, and maybe I didn't something I didn't cover.
When's a good time to refi?
Now. Interest rates are the lowest they've ever been, right? They're within a hair of the 50-year low. They've been hovering around that level for many months. Government has said they're going to try to keep rates as low as they can through 2014, but keep in mind the government doesn't control mortgage rates. They went up quite a bit this past week, close to 0.5%. They've retraced some of that a little bit the last 2 days. Today was not as good as yesterday, but I'd say the net over the last week is they're up about a quarter. Will that hold? Will it keep going? We don't know. Depends on what happens in the economy. And it's not just the U.S. economy anymore, it's the world economy, what's going on. The European situation has helped keep our rates down a lot.
Maybe this is something that you and Sean can answer together, but for those of us who are refining, a big variable for us is what the house is going to appraise for. Mm-hmm. And so I guess the question is, how are appraisals being handled in Laguna these days? I've heard all sorts of horror stories about appraisers coming from out of area, don't know the market, et cetera, et cetera. So if you can
I could touch on that too, and I don't want to use up these guys' time, but somebody kind of help me monitor that, all right? Because I have no idea how long we've been talking. But
Well, it's something I think that
It's
everybody,
a very
all
important,
three of
yeah.
you should be interested.
It's a huge issue, and a few years ago, again, when everything started to collapse, government stepped in and they took away the independence of appraiser. That they've taken away the ability for mortgage brokers or mortgage lenders to choose the appraiser, and so what happened is all these appraisal management companies sprouted up, and these are companies that basically just randomly assign an appraisal to an appraiser that theoretically is local, but they don't really know how local they are. All the appraisers that were local sign up to get on the panel of these appraisal management companies so that they can get in the rotation and get appraisals assigned to them. But the system's not very good, and we do often have appraisers coming from too far away, and that's a problem because they don't know your market.
What's been the experience in Laguna lately?
It's gotten much better. When that whole program first started 2 or 3 years ago, it was called HVCC, stood for Home Valuation Code of Conduct. When it first started out, it was a big problem because appraisers were coming from Los Angeles or Riverside or San Diego to appraise in Laguna Beach. They couldn't have found Laguna Beach without their GPS system or their Thomas Brothers guide, And they didn't know North Laguna from South Laguna and the different markets within, and it was terrible. I haven't had much of a problem with it in the last year or more.
Except for the one that just happened.
Except the one that is this month. But it's the first one in probably close to 2 years that I've had a problem with. An appraiser came from Los Angeles. He botched it up terribly. And now he's redone it because we disputed it. There is a formal process to dispute an appraisal. But you get like one chance to go back. He had to, he had to either defend his appraisal or accept our information or redo it. And in the case of this one, he did come up with a higher value that met the sales price. But it was a hassle, and time's been lost, and there's other complications. It's like a domino effect if a deal doesn't close on time. But it happens less as time goes on because these appraisal management companies have gotten better at weeding out the bad appraisers and at selecting appraisers that are more local. But still, there are some that fall through the cracks.
I've experienced too, also, if you have a problem with them, and you can show this a bad appraisal, they will fire those appraisers pretty quickly.
Yeah, they'll remove them from their panel. They will eliminate them. But I have one complaint. I don't know if that'll do the trick. If there's a series of complaints, probably. And do enough people complain, or do I just say, get mad and go on to the next deal?
How relevant is the value that the Orange County real estate tax people give you once a year?
Completely irrelevant. I wouldn't even look at it.
It's not normally low or normally high?
No. I mean, it's so hard to say. I mean, you got Proposition 13, so the assessed value of your property is dependent upon the purchase price of it, depending on how long ago you bought it, so that plays a part of it. Nobody looks at that as far as analyzing or underwriting a mortgage loan. It's irrelevant. We need a current appraisal, and the appraiser has to look at the most recent.
I mean, they send you one every year because actually they've been bringing the appraisals down and charging you less for real estate.
Yeah, and you could, and I've had people that have taken an appraisal on a house they refinance and taken it to the tax assessors and say, hey, I want my taxes reassessed, and you can use it for that purpose sometimes, and that could work. But for the most part, lenders aren't looking at the assessed value.
Do you have any idea how accurate these software programs that certain banks have, where they just put your address in and they come up with some kind of value for your house during pre-qualification?
Can I speak to that?
Yeah.
You can, yeah.
Okay, because I was in the technology for many years, for real estate technology, and I was actually involved in designing some of those first systems, and they really work good for like cookie cutter types of places like Irvine, where there's a lot of the same houses. But here there's just there's too many variables, and it goes into like do you have a whitewater view versus an ocean, just an ocean view, or because they don't even get those types of things on what they call automated valuation methods.
And how about something like Zillow?
Again, they're almost
They're out the
actually they don't even. They came on the market that was their hot thing, but now it's kind of like pushed down of other things they have. Yeah,
so anything that a lender tells you about what the value of your house is based on their software programs, you probably should take with a grain of salt.
Yeah.
To a degree, yeah. I mean, Sean's right. If it's a cookie cutter kind of environment, not Laguna Beach, but
we're talking about
Santa Margarita, the places like that, I find Zillow to be pretty accurate. But you get here where there's no two houses alike, you've got different views, and it's not going to be accurate. But yet, lenders have nothing else to go on until they get the appraisal either. So, I take it with a grain of salt in Laguna Beach. Yes?
So with more and more people being involved in small businesses, entrepreneurial pursuits, self-employed, an aging boomer population who's not going to be retiring at 65 and is going to be not involved in a conventional employment situation, are you seeing any programs coming on in the mortgage market, or any softening among the programs that are there for qualifying for people who don't fit the traditional employment situation?
Very slight, not a lot, to be honest with you, okay? The rules are basically this: if you're self-employed, we're going to average your income over the last 2 years from the tax returns that you give us. And not only are we going to take the tax returns and underwrite to that, but the lender is now required to validate your tax returns directly with the IRS. So they're going to get the tax transcripts from the IRS and match it. They better match, or you're in deep trouble. Okay? But yes, you have to. If you're not reporting the income on your tax returns, then you're not going to qualify. One of the trends I'm seeing, though, and this is a little bit helpful, when you run a loan through the Fannie Mae Freddie Mac automated underwriting program, sometimes it says it only wants 1 year tax return instead of 2. Okay? If you've been self-employed a long time, if you've got good equity in the property, if you've got high credit scores, it'll be a little bit more liberal that way. And I'm finding a lot of people have had a better year in 2011 than they did in 10, and 10 was better than 9. So, you know, in certain situations, I'll pick and choose what lender I deal with based on that. If I've got your tax returns and I see the most recent year is better. If the most recent year is worse, though, they'll throw out the better year previous to that and use, you know, so it's difficult. And I'm sorry,
But
that's the way
actually,
it
a
is.
lot of these guys, Don, you probably guys can